Well, good evening, everyone. I need to check, make sure I am recording. Yes, it looks like I am recording. Okay, good. Glad to see everyone attend tonight. It looks like I've picked a good time to hold these sessions. Usually during the semester, I do it during the daytime and only get one or two people showing up. So I'm glad that we were able to find the time when many of you could attend. And I can also see, hopefully you're not the procrastinators of getting your homework and quiz done, because Sunday midnights will be the due date from now till the end of the semester for quiz and homework. We're going with last week we talked about actually analyzing transactions and seeing whether or not how the accounts interact with the different transactions. So we talked about when you see a transaction, figuring out whether or not you're increasing that account or decreasing that account. This week we're going to drill down more on analysis and start to learn how to record these transactions. Before I get started, a couple of housekeeping things about the course that I wanted to share with everyone. I'm having a problem getting email notification. One of the things that I like to do is keep the Google email account open while I'm at work all day long, in case anyone has a question. And same thing on weekends, I like to check that same Google account so that I can get back to you all as quick as possible. This new Blackboard Ultra has a function where you can message me. The problem with it is not that I don't get it, but at the end of the day, which is midnight, which means I'm asleep, I'll get a listing of everybody that messaged me, and then I can go in and respond to messages that way. And that's a little clunky if you're trying to get my attention sooner. So please go to the instructor information. And when you go into the instructor information, it'll have my email address there, copy and paste it into your email account and contact me that way. That because I keep that account, like I said, open. I'm looking at it several times a day, and I can get back to you a lot faster that way. Okay. The other thing is I want to remind everybody that I'm going to post the grades at least every 48 hours, but it'll probably be every 48 hours. So if you don't see your grades show up right away, that's the reason why. Again, this is a new function. It used to be when you got done your Connect assignment, it would automatically transfer over to the Blackboard gradebook. Doesn't do that anymore, though. I got to go and actually post each grade individually. And so I try to set aside a time I can go and do that all at once. And I am working my way through the discussion questions. So you all should be able to see those grades. And to let you know how I grade these, if you responded to both requirements, that is an original posting and then a reply to someone else, you'll get 100. But if you only do one of the two, you're going to get a 50. So it is a graded assignment. You want to do that. Want to remind everybody that the practice problems are not graded. Grades may show up in your grade book. I'm still waiting to see how that's playing out. I could go back in under the old Blackboard and you know, keep them from being viewed, but I don't. This new one, I'm still learning the system. So I guess what I'm trying to say is, what you might want to do, since the homework and practice are like identical in how they're laid out, you might want to just do the homework, because there is a lot of time required by this course in doing the assignments. So go in, do the homework, and then if you need more work on it, go back into practice and work on it. If work and practice works for you before doing your homework, I'm great with that. I want to see you successful with it. The other thing that's good about practice is you can save those problems, go back and work them in preparation for your tests and in preparation and studying for your final. Okay. All right. So the basis of financial statements is where we're starting with this chapter. And again, we've already looked at identifying the transaction, looking at the source documents like invoices, checks, and bank statements and that kind of thing. and recording those to what we call the general journal. And then we're going to post that information from the general journal to the ledger. We're going to constantly be using the accounting equation. That's why you have to be familiar with it. Again, I mentioned with this third bullet that we're going to record into a journal, and then we're going to put that information into a ledger. A journal has a summary of each transaction. The ledger is for each individual account, so you can keep track of what your account balances are. And then finally, we're going to do the trial balance and the other financial statements to start proving that the information that we posted is correct. Well, this is not moving for me. Hold on a minute. I wanted to wait till now when we had more folks on to let you know that I need for everyone, if you have a video, to turn off your video. We have some students that have limited bandwidth, and they'll keep timing out if someone else's video is coming through the pipeline. And also, please keep yourselves on mute. And I don't mess with mute much because I do want you to unmute yourselves and ask any questions as I go through all the particular information in the slide and when we talk about some of the problems. So here's your source documents: bills from suppliers, sales receipt, checks, purchase orders, payroll records, and bank statements. And this is just a limited number. There's a whole bunch more than this. So what is an account? We've been working with accounts already and doing your homework in chapter 1. You've been working with accounts like cash, supplies, accounts payable, common stock. Okay. So an account just records the increases and decreases in that particular account. The reason what's going to happen is at the end of the month or whatever other accounting period we're using, when we go to post those numbers to the trial balance, we're going to be transferring the end of month balance is essentially what we're going to be doing. So after recording, like say a full month of transactions, we're going to take the balance at the end of that that's supposed to be in the account and put that on the balance sheet, or the trial balance, I'm sorry. Now, general ledger is different. Well, no, I'm sorry. General ledger is where we're going to put, it's not, no, I'm sorry, I misspoke. The general ledger is not where we're going to put. We're going to put it in this account ledger. So every time you have a cash transaction, it's going to go into the account ledger. You're going to post it to the general journal first, but then you're going to put it into the specific ledger. And the general ledger is a summary of all accounts. And an example of that would be, let's say you have a rent-a-center and you probably have 300 or 400 accounts receivable. Well, we're not going to put 300 or 400 different accounts receivable on a balance sheet. We're going to put a general ledger called accounts receivable, which summarizes all the individual ledgers. This is Exhibit 2.1 in your book. I would strongly suggest this be one of the things you bookmark to make sure that you're putting the accounts under the right part of the balance sheet. And again, we've already started using some of these accounts in chapter 1, but we're going to be adding accounts every week. So this particular diagrams, well, this not particular one, but the list of accounts is going to start growing. So these are some examples of asset accounts. Remember, assets are what you own. Liabilities are what you owe, as indicated. And I want to go back here a minute. I'm going to give you some key words to keep in mind here, okay? If something is a receivable, you can automatically assume it's an asset. Accounts receivable, notes receivable. If something is prepaid, you can assume that it is an asset. Two prepaids that come to mind that we're going to be working with is prepaid insurance and prepaid rent. Why is it an asset? Well, even though you've been given the money, it still belongs to the person who paid it to you until you provide the service or you use up the particular product you bought. And let me give you an example of car insurance. If you've ever canceled an insurance policy, an automotive insurance policy, and you're prepaid it for 6 months, they're going to refund you the difference for the unused portion of that insurance policy. That money is going to sit there in a prepaid insurance account until you go through a period of time to where it gets used up. And we'll have some exercise show you where that money is going to be applied. Rent, same way. If you could argue, well, what if you have a lease? This really wouldn't apply. But if you, in a particular example I'm thinking of, let's say you prepay your rent for a year in advance, and you leave after 6 months, and maybe you have a clause in the lease to where if you get moved for a job or something like that, you're not responsible for the rent from the time you have to move. Then you would have that money refunded to you. So in other words, the company's not going to capture that as revenue until each month passes and you use up that rent. And so it sits in a prepaid rent account, and that's considered an asset. And I'm not sure if I mentioned this last week or not, but accounts receivable, you're probably thinking, well, wait a minute, I don't have the money yet for that. How can it be an asset? Well, you can take your account receivables. In fact, the short version of that is they're called receivables. And you can go to the bank. You can sell those receivables, usually for about 70 or 80 cents on the dollar. But because you can get money for those receivables, it's still an asset. And that's why it falls there. So don't get these confused with liability accounts. Now, for liability accounts, whenever you see the word payable, it's a liability. That means you owe it. And it's not just, buying merchandise, getting repairs done on credit, that kind of thing. You also might have gone ahead and borrowed money or signed a note to cover debts that you already owe. So if you owe it, again, the payable kicks in. Now, the other key word is unearned. And what unearned revenue is let's say somebody prepays you for work. And example, this would be, well, magazines. You subscribe to magazines for a year. Well, you're not going to record that annual subscription you got as revenue. You're going to, as you send out each magazine, and this is literally done by the big publishing companies, as you ship out those magazines, then you will move the money you've been prepaid from unearned revenue over to revenue. And you'll see some examples of that where you'll have a description where a customer prepaid their landscaping for 6 months. And you need to know that when you analyze the transaction, that you're going to be debiting cash and you're going to be crediting unearned revenue. These are different types of equity accounts. We'll get a little bit into the weeds of this in a few minutes, so you understand this better. The one thing I want to mention under common stock, now we've seen a common stock account in the first chapter, but in this sense, these are common stock accounts. By the end of the semester, we're going to be showing you what falls into this common stock account. Like there's going to be where you pay more in. So that paid in excess of par is what it's called. You're going to have par stock, which falls under the common stock account. So there's going to be 3 or 4 accounts you're going to learn that are actually within this common stock area of the equity accounts. Dividends is a standalone account. Revenues and expenses are not, as we've seen, chapter 1, that you could have 2 or 3 or 10 different types of revenue accounts, depending on where the source of the income's coming from. And expenses can be as many as you're going to have business expenses to subtract from your revenue. So we've already been exposed to this, but it's worth reviewing. I had some emails where some folks were confused on this. If you're going, when you're analyzing the equity account, all right, common stock is going to be, if you have an increase, it's going to be a credit. Revenues and increases a credit. For dividends and expenses, the opposite is going to be true. If you're going to have a decrease in those accounts, but it's going to raise the value of those two accounts, it's going to be a debit. And so that's why you see it laid out the way it is. Best thing to do, if you've got this problem come up in homework, take your revenues minus expenses first, then take your common stock minus dividends, and then add the two together. This is what a chart of accounts looks like. Every company has one that has an accounting system. You'll see numbers in front of each account. That's just to show you the order in which really you're going to work them. You're going to have a set of books on the shelf. You'll have a cash ledger numbered 101, accounts payable 201. But you keep this in mind because this is the order you're going to want to list them on the trial balance sheet. And so that'll help keep you organized. Again, you want to bookmark exhibit 2.4 because you're going to be creating income statements and balance sheets and trial balance sheets, and you're going to have to know what order these go into. You just can't put them in willy-nilly and have cash and then go over to accounts payable and then maybe to rent expense. You'll see what I mean when we look at the samples. So a lot of folks come into accounting thinking that a debit's a plus and a credit's a minus. That is not true. A debit, what you do with a debit and what you do with a credit is going to depend on exactly what the normal balance of that particular account is. We'll get into that in a minute. Now, it's kind of clunky for us to do ledgers in this class. Number one, because they would fill your whole screen, and we may be doing some ledgers. But when it comes to substituting what a ledger looks like, we're going to use what's called a T account. So as you can see on the top line of the T, you have whatever the account's called, whether it be cash, equipment, supplies, common stock, makes no difference. Then whenever you have to debit that account, you're going to add it to the left side. And whenever you have to credit that account, you'll add it to the right side. We'll be working some examples, so you'll see. So what you need to know before you post to your T accounts or to your ledgers, actually to the general journal, you have to know this. You have to understand what accounts are being used and what their normal balance is. So let's say we analyze a transaction where we paid an account payable. Well, if we're paying something, and by the way, you need to be smart enough to analyze that, get in the habit of that when you're working problems, because I'll have students reach out to me every semester and somebody will not get a problem right. And they don't see that something was paid for, which means a decrease in cash. Okay. They don't make that connection for some reason. And so I have to get back to them and say, well, you know, they're talking about the cash account, because when you pay for something, you're going to pay for it with cash. There's nothing else out there to do that with. And so don't get confused or thrown by that on problems. But when you, in our example where we pay a bill, say we paid $1,000 statement balance that came in. We're going to go ahead and look at, see what's the normal balance for cash. All right, that's step one. Well, the normal balance for cash is going to be a debit. A normal balance is an increase in the account, but we're not increasing cash. We're paying out cash. It's the opposite of the normal balance. And so the opposite of the normal balance for cash is going to be credit. So we're going to credit the cash account $1,000. Next, we're going to go over to liabilities. Well, we're going to decrease liabilities because we're not going to owe $1,000 anymore, right? Well, the normal balance for accounts payable is a credit. So we're going to do the opposite of the normal balance since we're lowering the account. And so we're going to debit accounts payable $1,000. Uh, 2.7 is something that you want to definitely bookmark. Okay. If you take a look here, I want to point out the fact that if you're confused as to whether or not an increase in any of your equity accounts, where they fall, again, just look at this chart and you'll see. So let's say you do a job for cash. And again, we'll stick with $1,000. You got $1,000 from a customer for some kind of service you provide. Well, the normal balance for assets is a debit. And so we're going to debit cash $1,000. Easy one there. And then we're going to go over and figure out, what do we do with the other 1,000? We need to come up with a credit. If we have a debit, we got to have a credit because both sides have to equal each other when I'm putting this in the general journal. And so we'll go over to revenues and we'll see that since it was revenue we took in, okay, that cash payment was for work done. That means it's revenue. Then we're going to go ahead and credit revenue for $1,000. This is a summary of transactions. I'm trying to see if this came from the last chapter. Yeah, if we would have summarized all of our cash transactions that we looked at in the last chapter, this is what they look like in a T account. As you can see, where we received money, it was debited, and where we paid out money, it was credited. Now, when you have you can see the balance is a debit balance, okay? And you can see that if you were to total up all your cash, which is $36,100, and then total up all your payments, $31,300, you're going to have a $4,800 balance at the end of the month or at the end of the year. I'm going to stop here a minute and see if y'all have any questions. If anybody has any questions, go ahead and take yourselves off mute. Okay. I'm not seeing anybody come off mute. So, all right. Next slide is about, this is what journals and ledgers look like. If you ever wondered, the show called The Office, and they're supposed to be a office supply company, right? With heavy focus on paper. Well, in the transition, actually, I don't want to say in the transition, going back in the 70s and 80s, there's still a lot of companies that weren't computerized yet, and they were doing their accounting on paper. When I took my first accounting class back in 1973, no, make that 74, we had to go out to an office supply store and buy ledger paper, and we would do everything you're doing in class on the computer on paper and pencil. Okay, so that's really what you're looking at. Very rarely done, although some companies still do it this way. The ones that do it this way are very old companies that have been in business a long time and are probably very, very small. Could you imagine a Walmart doing it this way? Not going to happen. And for some reason, I'm not moving. So when you go to put some, and you're going to replicate this, by the way, in your homework. So when you're posting transactions, and again, this is our example from chapter 1 that we started off with. owner invested 30,000 in cash in the company. Well, we're going to put the date in first in the first column. Then we're going to list the debits first. You always list the debits first. You always list the credits second. So you have to determine what your debits and credits are going to be before you post into this general journal. So you're going to debit 30,000 in cash, which was the initial investment, and then you're going to credit common stock $30,000. Now you'll see that there's a remark section right below that. Nowadays, since everything gets posted through QuickBooks and other similar programs, you'll see that there's always a memo or notes section where you can put in the information received investment by owner. That's very important because time erodes memory. And if you don't know what you spent the money on, you'll agonize for hours until you find out why. Because when you get done at the end of the month, or at the end of the year rather, your reward for doing all this accounting is you get to file a tax return. And you have to know where to put these numbers on the tax return to avoid having problems in an audit. So this is an example of journalizing your transactions. Now, after you get done posting to the general journal, and by the way, I forgot to mention this. If you're looking at a debit and credit column, right, when you get done the transaction, make sure both equal each other. I occasionally get emails from students in the course where they don't know what they got wrong. And if they would have totaled their debits and credits, it probably would have showed them where they made their mistake. You know, right here we have one debit, one credit. We're going to be doing some problems where you're going to have multiple debits and credits. And you have to analyze a transaction properly and post it properly to avoid a problem. Next, you move the numbers off the general journal into the general ledger. And as we can see with the first line of cash, you're going to open up the general ledger for cash. You can see at the top says cash account number 101. You'll put in the date. You may or may not need an explanation. It's not required. You'll put in $30,000. That's a debit. And then you'll go all the way over to the balance and put in the $30,000 as a balance. Then you'll repeat the process for common stock. However, this time, since the normal balance is a credit for common stock, we're going to put it in the credit column. And again, put the balance of $30,000. So it's not difficult. You just have to keep it straight and not try to do it out of order, because that's what will get you into trouble. Okay, so again, the procedures. You identify the transactions in the source documents. You analyze the transactions using the accounting equation. So in other words, you're going to figure out what your debits and your credits are. Okay. Then you're going to put them into the general journal, and then you're going to post them into the T accounts, which is what we use in place of the ledger books. So our first transaction, Fast Forward receives 30,000 cash in exchange for common stock. To post this, we're going to record first the debit of cash, and we're going to put it in the debit column, $30,000. Then we're going to record the common stock transaction for 30,000. And at this point, I would suggest that you total both columns to make sure they match before you post to the ledger. If it looks okay, then you go ahead and you'll post the cash to the cash ledger or T account, and the common stock to the common stock T account. In this transaction, you'll see that we bought supplies for cash. So when we go to do the general journal, we're going to list the supplies first, and the debit's going to be $2,500. Why is it? Why are we debiting it? Because we're increasing the supply account. When we go ahead and we post the cash, that we spent, it's going to go in the credit column because we lowered the amount of cash that we have in the bank. And as you can see, we go to post over to the T accounts. We're going to debit supplies for $2,500. We're going to credit cash for $2,500. Okay. If you recall last week, we bought equipment for $26,000. So again, we bought it, right? In this case, it does tell us for cash, but it's not always going to say for cash. It's going to just tell you that you paid for the equipment. Okay. So keep that in mind. So we're going to debit a new account called equipment because we're buying an asset, just like in the last transaction. And so we're going to debit it for $26,000. Then we're going to debit, credit cash for the check we wrote, $26,000. We're strictly working off of what accounts we're increasing and where it falls. So this is why you really have to learn your normal balances. It's really going to help you if you understand if we increase assets, it's a debit. If we increase liabilities, it's a credit. If we increase equity, it's a credit. And then if we increase revenue, it's a credit. Increase expenses, it's a debit. Okay. Next one, we purchased $7,100 of supplies, and we had to do it on credit. Why? Because we're running out of money. You look at the last year transactions. So we bought supplies. We've increased supplies. So we're going to debit supplies because that's an increase. And by the way, that's going to be our first entry because we list our debits first. Next, we're going to go ahead and we're going to credit accounts payable because now we owe somebody that $7,100. And then when we go to post to the T accounts, we will post the supplies over for $7,100 as a debit, and we'll credit accounts payable $7,100. In this particular transaction, we did some consulting work. I paid $4,200. So we're going to debit cash $4,200, and then we're going to credit consulting revenue, which is consulting revenue, $4,200. I'm going to skip ahead here and see if I can find a multiple one to go over with you. I want to make sure that I get all these slides in by the top of the hour. Here we go. So if you recall, last week we looked at where we got $1,600 for consulting work, $300 for rent. So we billed the client $1,900. Keyword, billed. When you see we billed a client or extended credit to a client, it's automatically accounts receivable. Okay. So we're going to debit accounts receivable, the full amount that we got, that are owed for what we provided to a client. So we're going to debit accounts receivable, $1,900. We're going to credit consulting revenue, $1,600, and we're going to credit rent revenue, $300. Somebody pays on account. They pay us $1,900 for what's owed from the last transaction, as a matter of fact. So they decide to go, they're paying $1,900, full amount of the bill. So we're going to debit cash the $1,900, and we're going to credit accounts receivable $1,900. And again, you can see how it posts to the different T accounts. All right, I am going to show you what all these postings do. I'll come back to unearned consulting revenue. Well, I know it's here somewhere. There it is. Okay. So after we post all those transactions to General Journal and then to the T accounts, this is what the T accounts look like. And by the way, this is what you're going to have to fill out when you do the accounting cycle problem, which is going to be due, I think, in about 4 weeks. So in essence, this is what an end of month looks like. Okay. And you'll see every account has an end of month balance. So these balances are what's going to get carried over to the trial balance. And we'll get into the trial balance in a little while. I just wanted you to see, instead of using ledger books, we're using the T accounts. And this particular part, they have it in order by where it falls on the balance sheet. If you were looking at a balance sheet, you'll see all the assets are done in liabilities and equity. Now I'm going to take you back to some. Let's see. I think we're there. Nope. Okay, this is the one I wanted to show you. So fast forward receives $3,000 in cash in advance of providing consulting services to a customer. A lot of business will take retainers. If you go hire an attorney, that attorney will charge you a retainer, and they'll give you an estimate of, well, I'll give you an example in my particular business where I do representation work before the IRS. Somebody wants to come in that owes a lot of money to the IRS and they want me to try to settle with them. I'll ask for either a $2,500 or $5,000 retainer, so that, and depending on what the problem is they have with the IRS. And then I hold that money and then I record the hours that I put into the case and whittle away at that retainer a little bit at a time. Well, when they walk in the door, let's say they give me $3,000 for an offer in compromise, then I'm going to debit cash $3,000, and then I'm going to credit unearned consulting revenue because I haven't earned it yet. It technically belongs to the client. At the end of the work I do, if it turns out that I didn't use up all the money, I'm going to return that under the unearned consulting revenue that I didn't use up, and then the transaction will be reversed. Okay. So again, students have a problem understanding unearned consulting revenue. You really got to think through the terms in these examples of the problems that, or the transactions you're going to be given in the homework, to make sure you understand exactly what's going on here, what needs to go on the books. I'll have, for some reason, I've had students debit accounts receivable when unearned consultant revenue is involved. I'll have students ignore that it's not been earned and go directly to revenue. So just be careful there. Okay, this is the one we're just at. All right, now we're going to talk about preparing the financial statements. So we're going to list each account in order as it is in the chart of accounts. Can't mix them up. You got to have them in the right order. All right. Then you're going to finish computing what the balances are in each of the accounts. So you're going to add up the debits and add up the credits and figure the difference. If the normal balance of an account is a debit, like cash, you should have a debit balance. If the normal balance, say, is a credit, like accounts payable, you should have a credit balance. It's okay to have zero balances, but whatever the normal balance is for that account, that's what where your balance should be. And then you want to make sure that the debit balances equal the total credit balances at the end of preparing this trial balance. This is what a trial balance looks like. You can see you have all of your assets in the correct order. Then you have all of your credits in the correct order. Okay. You can see next is dividends. Then you have your revenue and expenses. Now, from consulting revenue down to total, down to utilities expense, you could pull this information out and do an income statement. In fact, that's what we're doing later. What happens if you make a mistake? In other words, what happens if your trial balance debits don't equal your trial balance credits? Well, the first thing you're going to do is you're going to verify the trial balance columns to make sure they're correctly added. So you start with the trial balance. You don't go all the way back to the beginning of all your transactions. All right. You work your way backwards. Next, you're going to verify the account balances that are correctly entered onto the trial balance from the ledger. So you're going to go back and look at each ledger or each T account, look at the ending balance, then you're going to compare it to what you put on the trial balance sheet. You know, a lot of times you might have just transposed a couple of numbers, carrying it over. Next, you're going to see if the debit and credits are mistakenly placed on the trial balance. If you still are out of balance, you're going to recompute each account balance in the ledger. So you're going to go back to your T accounts and you're going to recompute what that ending balance is in each T account. If that doesn't produce any errors, then you're going to go back and you're going to have to verify that every journal entry you made is correct. And then finally, you're going to verify that the transactions you made were in balance. Remember, I told you in the very beginning that you have to total your debits and credits in the general journal, not the ledger, but in the general journal. Both columns are equal, then you can move on to the next general journal entry, because your debits should always equal your credits for each transaction in the general journal. As you can see, when we finish the trial balance, from there, we're going to produce the different end of accounting period statements that our stakeholders are going to use to find out information about our business. And as you can see, the balance sheet, whether it's the beginning balance sheet or the ending balance sheet, in other words, a balance sheet for last year or this year, all it is a snapshot in time. You could take a balance sheet for any company today, January 23rd. Okay. It just shows what the balances are in the accounts for a point in time, on a day in time. However, the income statement is over the entire accounting period. So is a statement of retained earnings and cash flows. So if we pulled an income statement on January 23rd, it would cover I need somebody to mute themselves. I'm getting some background feedback there. Please check your mics to make sure you're on mute. What's happening is my voice is coming through on the other end because somebody doesn't have their cells on mute. Well, let me see if I can identify who needs to mute. All right, looks like everybody's muted now. Okay, we can continue. Okay, so I was talking about the statements that cover a period of time. So if we run any of these three statements, statement of cash flows, statement of retained earnings, or the income statement from January 1st to January 23rd, that would give us a snapshot of time. And I'll give you an example of this. When I was in the restaurant industry, we used to run profit and loss statements. And well, we really didn't get involved with balance sheets because that was higher level in our organization. But when we're dealing with individual restaurants and districts, we would run an income statement monthly we would do another one quarterly and do another one annually. The quarterly profit and loss statements, which showed a 3-month period of time, were used in determining the manager's bonuses. And so we would be able to see a period of performance over whatever stated period of time. Now, at the district level, we used to run them monthly to see how they were performing from month to month. In fact, we did a short version of an income statement weekly that they had to turn into us as district managers and directors in order to be able to make sure they're on track to meet their goals for the month or for the quarter. Same thing with statement of retained earnings, same thing with statement of cash flows, because the statement of retained earnings information is based on what your profit is off of the income statement. So these are the 4 financial statements and their purposes. I'm not going to go in the weeds on this. These are in your book. And I covered a lot of this in that last slide. This is what an income statement looks like. As you can see that we have the total revenues here, and we total those up, and then we total up all the expenses. When we subtract the expenses from the revenue, it is net profit or net income. Hopefully we won't have a loss because that's not good. After you do your income statement, then you're going to take that net income. You're going to go down to your statement of retained earnings, and you're going to put it on the second line on your statement of retained earnings. First line is going to be your retained earnings that are carried over from your previous accounting period. But it looks like since we have a startup, we don't have any beginning retained earnings. If you recall our example, the company started when he contributed the $30,000. Then we're going to subtract dividends, and dividends we'll get into at a later time on how they're decided. We're going to give you that information for now. Okay. And then finally, when we subtract the dividends from the balance of the top 2 lines, that's going to give us our retained earnings. And those are going to go onto the balance sheet. And as you can see down here in green, retained earnings is filled in for $31.95. Where are you getting the rest of these numbers from on the balance sheet? Well, you're getting them from the T accounts. These are the ending balances in the T accounts or ledgers. Okay. And same thing for the income statement. Where do you get your revenue, total revenue from, and the total for each of the expense categories? You're going to get it from the T account balances. And just some things you should know. I don't think you'll really be testing on this. Dollar signs are not used in general journals or ledgers. They appear in finance. They do appear in the beginning, usually on financial statements. They're the first and last numbers in a column. Now, our 2 ratios for this week. First is the debt ratio. I think there's 2. I'm beginning to doubt myself. The debt ratio is the total liabilities divided by total assets. And the higher the ratio, the worse it is for the company. So if this was a 1, that means if it had to liquidate, there wouldn't be anything left for the shareholders. You really want this to be like at a 0.5 or a 0.75 at best. If it's a 1 or more, you're in trouble. And you'll hear companies will clean up their debt. Mainly is to make this and several other ratios we're going to learn to look better. And here you can see Costco and Walmart. For the current year, Costco is 0.02 higher than Walmart. I would say they're close enough not to worry about it, but you can see that they've improved from 2 years ago where they were up to a 0.7. So they probably saw that they had a problem they needed to fix and did something about it to eliminate some of their debt to make this ratio look better. Okay. Anybody have any questions that they want to ask based on what we covered? You have to unmute yourself if you have a question. Okay, I don't see anybody asking any questions. And I have a Chihuahua that wants to go out. So the statement that you'll want to put on the survey, and remember, you only have to do the survey one time in a unit, and it has to be, before the due date of the test. So for tonight's statement that I want to have put in the survey is the normal balance is tied to whether or not you select a debit or credit for your transactions. I'll repeat that. The normal balance is tied to your selection of whether or not you're going to use a debit or credit in your transactions. All right. Have a good week. Feel free to reach out to me if you need help with your homework or your quiz or any other issue that comes up with the course. Thank you.
Thank you.